Okay, thanks everyone for coming. We're going to have a quick little presentation on debt and what commercial debt is, with a tiny mention about what public sovereign debt might be as well. Can anyone, first of all, distinguish between public and private debt for us? So, big, really sort of straightforward difference is that public debt and sovereign debt is that borrowing by the government, and governments borrow from large equity investors and other institutions, and then at the same time there's commercial debt and private debt, which is what companies and banks and other people, other institutions such as those, borrow from each other. Okay. So we've got a few different types of debt. They're vaguely sort of readable. Simply put, it's a fixed or variable rate interest, and the debt is usually assigned for a fixed term. So that means that unlike shares or other sort of interests which kind of go on indefinitely, debt is something that's issued for 5 years or 3 years, maybe a few months. It has a specific deadline or a date on which it will mature, and the rate of interest that a borrower will pay on that debt will vary or can be fixed, and there are different rates, sort of like index rates, inflation rates, lending rates, that determine how much interest a borrower has to pay on a variable rate of debt. And if it's a fixed rate debt, then you'll know how much that is. So in context, the easiest way to explain that is if you as a borrower take out a mortgage on a house, you'll get, say, £200,000 to cover the cost of buying your house. And if it's fixed rate, you'll pay a definite 5% per year on that interest. And if it's variable, it might be 5% 1 year or 1% the next year, depending on interest rates that the mortgage is set to. So it can vary, and that can either be a good thing or a bad thing, depending on whether the interest rate goes up or down. Little distinction as well, that corporate and government bonds are traded on bond markets, and mortgage and credit notes, which we'll come to in a bit, are traded on credit markets. We've sort of come into this a tiny bit in some of our classes, but there's a hierarchy of creditor interests, which which applies to company and commercial debt only, really. So that's how people work out, or an administrator, whoever's doing the winding up of a company, will work out how or who gets their money back first. So we've got secured, which is divided into fixed and floating charges. You can sort of have a bit of a browse of those in your own time. They're kind of a bit more complicated. Preferential interests are those of employees. Shareholders come last in all of this. So if a company has a secured debt against its assets, then that creditor or the bank that's lent them money will be the first out of all of those people to receive their assets back, their cash back. So a sort of straightforward example is HMV may have had borrowed, say, £10 million to open a few stores somewhere, and if they're a secured debt against the assets of the company, then that £10 million will be taken back by the bank that lent it to them first, and their employees will get what's left if they're still owed wages and things like that afterwards. And that can be quite sort of significant in law in general, as we'll be trying to work out which companies, which parties get their money back first and which don't. It's also then quite significant for shareholders too, because at the bottom of the pile they might not get their money back at all, and that's often the case. So government bonds, they're issued by the sort of central bank or the kind of main banking institution of any country. Got a couple of examples there. So the issue of whether it's a fixed or a fixed maturity period, I tend to think that 1 to sort of 3 and 5 year debts are the most common for governments. Fixed or variable rates of 0.5 to 5% often, and thinking back to sort of like some news that's been going on recently, the Euro crisis, has anyone noticed any particular countries that have had their government debt borrowing rates sort of increasing? There's a clue there.
Greece.
Greece, okay, yeah. Greece, great place to start, okay. And why has that rate of borrowing increased, do you think? Think about people's outlook for the Greek economy. Do you think they're really confident in it? Not too confident in it. So there's some concern by banks and lending institutions that the Greeks might lose everything and say, we're not going to pay back this money. So there's a risk factor there. And rather than the Greek debt being seen as like a secure, good place to put your money and return and get an investment back, so, or return on your interest back, it's seen as a slightly more risky place. So investors want to charge a little bit more money to take account of that risk. So we've seen that over the Euro sort of crisis period, Greek debt has sort of varied from around 4% and may have even got up to 7.5% on the sort of 1 to 5 year bonds that it issues. And if you think about it, 7.5% for a government paying back on large amounts of billions and billions of euros, it's quite a substantial amount. And there comes a point when that amount of repayment is unsustainable. Yeah, Kaylee?
What's normal?
What's normal?
What do we have at the moment?
Any thoughts on what we might have at the moment? That's a good, perfect question, because we're about to have a little look at it. If I go to this next one, this is a Bloomberg, so it's at the top there. Bloomberg are like a really useful sort of news and information kind of source, like Reuters. They give really good financial news and information. They've got, well, it's not too clear there, they've got the current rates for UK bonds. So those are the bonds that the government gives out to people. So it issues a bond, says in 1 year's time, I'm going to pay you back the money you've lent to me, and on top of that, I'll pay however much interest. So we've got the UK 2-year yield is 0.4%, which is pretty low. Obviously, the government has been doing quite a lot of work to cut its spending and induce confidence in the UK in order that investors around the world look at the UK and think they know what they're doing, they're being very cautious with their spending. We don't think that they're going to default on their debts anytime soon. So that's when you'll hear Cameron and George Osborne going on about the importance of maintaining low interest rates on government debt. That's so that we don't pay out too much interest on the money that we borrow. In contrast, so Greece, Italy, Spain, Portugal, Ireland too, have been paying more around the 5% interest rate for the same 2 or 5 year bonds. There's also a bit of a difference between the 10 and 30 year interest rates, which take account for the fact that investors aren't really too sure what might happen in 10 years' time. It might be slightly riskier to have your capital as an investor tied up for that long. You don't know quite what the government will do. Maybe there'll be a change of government, and that takes account of that sort of future risk that your money would be tied up for that long. Oh yeah, so we covered those. Let's see. Okay, so corporate bonds now. And can anyone think of why bonds are issued by companies? Yep, get capital, and what are they going to do with that capital? Yep, we're going to use it to expand, to have a new marketing campaign, anything like that. And why might they want to issue bonds rather than issue stocks on the stock market? There's one sort of key difference. Exactly, yeah. So with issuing shares and stocks, you lose a little bit of bit of control of the company, because with a share goes the voting rights at AGMs and things like that, and also the directorship. People with shares in a company can have a little vote and say how the company's run. Whereas with a bond or corporate issue of debt of some sort, it's just a straight contractual agreement that that the investor lends however much money for a certain time and gets a interest in return. Let's see. Corporate bonds are one form of sort of corporate debt, corporate borrowing. There are a few kind of subtle differences that may or may not be that important. The way that they're traded means that as the bond comes towards the end of its life, so a 5-year bond, if it's traded after 4 years, the amount that a new buyer would, or a new investor would pay for that bond might vary to reflect whether interest rates in the country have gone up or down as a whole. And I'll try and explain that in a little bit more detail. Let's have a look. So we've got the Guardian clipping on corporate bond rates at the moment. So one of BT's must be 20-year bonds, perhaps issued in 2008, launched with a yield of 5.7%. That's quite good. But as a whole, since the time that they were launched, interest rates in other areas of the economy have fallen, and so people looking to invest their money are not going to get as great a security or return on their investment as they think they might do by buying one of these BT long-term bonds. So Jimmy, the investor, has like 10 million or whatever, and he's looking around. He thinks he could put the money straight into a current account in a bank, and he might get 4% on his cash. He could also, perhaps, where else might he be able to invest his money? Yeah, absolutely. But as we've seen, what's one of the problems with shares? So do get control over the company, but if the company goes bust, you're slightly, yeah, exactly, you're slightly further down the hierarchy. And in addition to that, shares can be very volatile in their price and how much dividend they pay. So from one year to another, BT might have a little bit of bad news, they might go through a bad spell, and all of a sudden their share price drops maybe for a month. But if that's the time that Jimmy wants to get his money back, then he's subject to the share price at that time. Whereas because corporate bond as a debt is a fixed amount, he knows he's going to get exactly the amount he put in back when he sells, and also that he knows exactly how much interest he'll get on his deposit of £10 million. So there's some added certainty that you get with corporate bonds as opposed to investing or lending your money in different places. Certificates of deposit, they're kind of more like just putting your money in a current account, if you like, because they're usually done with building societies or banks, and they're a deposit where you actually sort of actively negotiate the terms and the price that you get for that money when you go to the bank. So rather than just walking in and saying, here's my money, I'm going to put it in a current account, I've seen on your brochure that there's a 4% interest rate, you would walk along with your stash, say, hi, I've got this much money, can we talk about the terms and what interest rate you'd be able to give me on this over a set period of time or sort of extended period of time. So again, it's a form of debt that the banks would issue, and you have a right over that amount of capital that you put into the bank. It's probably a fixed term, fixed return. So it may be at 4% or 5%. It may also be variable, linked to another rate of inflation or another index rate that we'll look at. As we can see, there's one drawback that banks often are pretty mean to people who want to take their money out before a certain date, so quite inflexible. Okay, so you may have heard the scandals about LIBOR and Euribor. Can anyone give us a rough outline of what they're about? Go for it, Kaylee. You look like you know. Yeah, I'm not sure either. I guess it's just fraud. So banks, in order to sort of maintain fluidity in an economy, one bank might say to another, I need to borrow some money because they want to go and spend it somewhere else, or they want to lend it to a business that's got a project. And the rate of interest that one bank pays to another when it borrows that money is called the interbank rate. LIBOR stands for the London Interbank Offered Rate, right? So, and Euribor, I guess, is the same European interbank offered rate. And the reason why it's so significant, and this might come up in interviews and stuff, is that a lot of commercial debt and government debt and other debts are determined or linked to these rates, because it's a general indication of how much interest people pay on borrowing in the country. So it's one sort of like issue that by fraudulently messing around with the LIBOR rate might affect just banks, but at the same time it might affect governments, and it will affect things like insurers who price their insurance products or annuities in relation to LIBOR. We've seen in America some of the mortgage owners people that have had property owners that were forced to foreclose during the 2008 crisis have started to sue banks in the US for their part in influencing the LIBOR rate, because potentially by changing that LIBOR rate, their mortgages may have got slightly more expensive in the short term and forced them to sell their houses, or to foreclose and lose it to their bank. And so it has a knock-on effect around the economy. That's why it's quite significant. There's also a little bit about RPI and CPI. Can anyone have a guess at all what they are? Similar to LIBOR and Euribor, they're rates which determine often how much people pay on their debts. So as students, many of us have got student loans, and our student loans at one point were linked to RPI, perhaps I get them mixed up, which was Retail Prices Index, and that's how much retail products increase in price per year. And I think the CPI might be Consumer Pricing Index, which is a wider gauge of inflation. So depending on which one our student loans are linked to, at one point we were paying, I think it took place during about 2009, when there was RPI fell so much that we would have actually been earning interest on our loans. The government quickly had to change it to another index rate so that they could actually still get a return on their lending to us. So another sort of two factors that determine debt repayment. So the debt crisis. Anyone give us a few factors that led to the 2008 financial crash? You know, it's about houses. What was that word that went with housing? Yeah, subprime mortgages. Great, cool. And did anyone hear about credit ratings as well? Cool. And sort of casino banking is another term that you might have heard. So this slide is a little bit difficult to read because it's too much on it, but there's a few things that contributed to it. And a lot of it is about debt and how debt was managed, how the way it worked. So let's see, you've got this is a little bit. This is the sort of most simple diagram I could find. Usually a bit more complicated. But during the sort of run-up to the debt crisis, banks and banking institutions, started to find ways of dressing up very risky mortgage assets as slightly better than they actually were. And you'll hear of something that sounds horrendously complicated called a collateralized debt obligation, which is basically a soup or a big pie of lots of different types of debt. And it's a very useful mechanism for banks to sort of form or to issue debt, because by piling everything in together, you're not just risking all of your money on mortgages, you're risking it on a few different things, like government debt, credit card debt, stuff like that. So you expect that that's going to be slightly safer because your money's more spread out. In reality, what it enabled people to do, and in particular credit rating agencies, enabled them to say that the debt was more secure than it actually was. And in return, that led to banks giving out loads of money for what they thought were good investments, and in fact turned out to be very risky, and the whole thing piled in. So we've got a bit of an explanation there. And a little bit further. Would anyone like me to write out what this CDO thing is? Because it's quite useful. You can just explain it as a melting pot of different types of debt.
Is this the collateralized?
Yeah, it's also hilarious to say. So yeah, this
Can you email your slides at all?
yeah, they're online on Prezi, so
On there?
on Prezi, so that means that you can share them out and stuff like that. I suppose.
What's Prezi?
It's like a slightly novel
Can you
kind
give
of
us
like
the link or something?
yeah, something like that. It's kind of like a fancy online presentation system, and you can just send people out a link. So it can work. So what do we think of when we talk about collateral? It's like, right, okay, someone's been watching too many action films. Yeah. So collateral is usually one thing to help or assist or back up another. Okay, so that's the first part. Collateral, we're talking about other forms of debt, like government debt, credit card debt, put alongside mortgage debt in order to make the mortgage debt look better.
So, sorry, I think so it looks better to the institutions?
Yeah. So many pension funds or banking institutions or anyone with money really, in the city will be looking to put their £10 million somewhere where it's going to a rate of interest. And obviously you want the most secure place possible, so less chance of not getting the money back ever, and also the highest rate. Now, it's this sort of security, or how good or bad any sort of item of debt is usually rated in by credit rating agencies as either A from AAA to C, and so something like AAB is slightly worse than AAA, and so on, all the way down to C. But at the same time, things with a sort of C credit rating, because they're risky, the people that are issuing the debt know that they need to offer a really attractive rate of interest. So the mortgages to individuals that weren't really able to pay them back were charged at quite a high rate. So they were quite risky. And once they'd all piled into this melting pot CDO, they've got houses and credit cards and government debt, I don't know how to call government, sorry.
How does it all get there into one? I know that's a metaphor.
No, absolutely. That's what lawyers and big banks spend their time doing, by packaging like 100 mortgages together. And if the people are really sort of well employed, they're teachers and stuff like that, they know the mortgage is good because you features are likely to pay back their mortgages, whereas if people aren't particularly well off and the mortgage is slightly riskier, then that debt item is going to be less healthy, less attractive to the investors. Just like that, yeah. It's your credit rating applied on a massive scale, so like billions of dollars or pounds rather than just yourself. So you then get this CDO thing, which is like a pie. We're going to draw a pie. Right? And because you've put in loads of C-rate mortgages and B-rate credit cards, credit ratings agencies, which we'll talk about in a second, will then stress this up in a really nice way and say, well, it's really diverse, so it must be secure. We'll give it an A rating, when really it's made up of lots of different C's and B's. So then banks come along and think, fantastic, right? We'll issue loads of capital because this stuff isn't going to go wrong. We know that it's been evaluated and scrutinised. We think that this CDO is very good. In addition, insurers, so we'll draw this out over there. Insurers come along and say, just in case this CDO does go bad, this high default of debt, we're going to back you up and say you're insured against that loss because we're so confident in it too that that we're happy to securitize that debt that you've just bought. And the major instance of this was AIG, which is a big American insurer, which went around giving out insurance to banks that bought these CDOs and said, I promise to pay the bank if it goes wrong. So that gives us a situation in which the debt that's being given out appears to be less risky than it actually is because of the credit ratings agencies giving it a good rate, giving it a good A or AAA status. And also at the same time, insurers such as AIG saying, even if this does go bad, which we think is unlikely, then we'll give you your money back. And this allowed lots of capital to sort of start spilling around. And eventually the whole thing unfolded, whereby at the start a few mortgage owners or credit card holders would not pay back their debt. They would default on it. So that means basically that the debt is wiped out, that the person that lent you the money gets nothing. It's effectively sort of pretty much just disappears, which is great for the person that's borrowed the money, but not so great for the person that's lent it out. And as one mortgage or credit card holder defaults, another one starts to, and at that point the CDO starts to look a bit thin. There starts to be less capital or less assets left in that because most of the people are starting to declare bankruptcy. And what happened with AIG, who the insurers said will back up, will honour this this asset because we've made a promise to pay the bank if the CDO is liquidated. AIG issued so many of these insurance policies to banks that in fact AIG ran out of money and had to default on its own insurance premiums and was bought out by the American government because it had backed up all of these unhealthy assets, unhealthy debts.
So they're not used to people. So what's the point when they do that? What do they get out of it? Does the bank pay them?
Yeah, absolutely. So just like an insurance premium on your house, you go to your insurers and say, if my house burns down, I want to claim the money back. I want £200,000 back. And for that policy, I'm going to pay you £1,000 a year. So you've got that security, knowing that an insurer has backed up the price of your house. And the CDO was just the same. The insurers said, if everything goes wrong and the CDO or defaults, we'll pay you however much money you've lost. Because as part of this kind of like massive crazy game, the insurers also thought that the CDOs were very secure. It is actually quite complicated, but the sort of surface and main parts that you need to know are really quite simple. And as far as law firms go, explaining the sort of the pie or the soup kind of analogy is absolutely fine, because it just shows an awareness of how banks and sort of credit institutions have, by putting everything together, made it look slightly better than it was, slightly less risky, when in fact it's just made up of lots of different forms of quite risky assets. I kept saying that we'll talk about credit rating agencies. So quickly, credit rating agencies are Standard & Poor's, Moody's, and one other that I can't remember. Something like Morningstar as well. They're not really very large companies at all. They're kind of like almost like a consultant that sits at the side of the deal saying, I'm an outside party or an independent party, I think that the debt is good or bad, whatever. And they're very trusted because they're kind of analysts rather than actual speculators. They don't put any money in themselves or actually sort of deal in the finance. They just put a stamp on it. So like PricewaterhouseCoopers, KPMG, those sort of auditors in the UK, they do a similar thing whereby they're kind of like an independent party. They've not actually got any interest in speculating themselves. But coming on to some recent news, just before, does anyone got any particular question before we sort of have a bit of chat about a couple of news things that have gone on this week?
Really
Go for it, Claire. Is there anything? You're okay, cool, right. This little diagram that's up at the moment is impossible to see here, but if you go onto the Prezi, it's pretty easy to see. It follows everything through. Do you know what? I don't know. I've just ripped it off somewhere. Let's see. It explains. Yeah, it's quite easy to follow, and it's got nice little pictures at each stage, so that helps. Okay. Let's see. I've got to make sure I don't mess up the recording, because I did that last time.